Welcome everybody to the hurricane webinar of the year. We try to do things differently at Stone Building Solutions. We're not going to talk about taking pictures and putting in lawn furniture. Everybody that lives in Florida knows that. We're going to get into the brass tacks about what to do and not to do to greatly affect your claim if you have one. Keep fingers crossed and hope that we don't. Florida needs a little break, but the waters are warm. My name is Tara Stone. I am the CEO of Stone Building Solutions. I have a long background in insurance claims. I used to be a manager with Allstate and State Farm for 10 years or 15 years, worked all across the country. Started Stone Claims Group. We're one of the largest public adjusting firms in the country, licensed in 19 states, have recovered close to $1 billion in recovery for condominiums. And now we are full service engineering and reserve studies. And with this time of year, I wanted to bring the best experts in the business together to give you this real world advice. I'd like to start off by introducing Carolina. Carolina, do you want to introduce yourself?
Hi, good morning, everyone. Thank you for joining. My name is Carolina Shear. I am board certified in plan development, condominium and plan development law, and my firm, Eisinger Law, is a boutique law specializing in representation of associations, condos, co-ops, HOAs, both on the association side, homeowner side, developer side. So we are a one-stop shop when it comes to all of the pertinent association needs.
Jordan with Cohen Law Group.
Thank you, Tara. Good morning, everybody. My name is Jordan Majeur. I'm an attorney and partner at Cohen Law Group. If you haven't heard of us, we are the largest first-party property damage law firm that exclusively represents associations, boards, unit owners, and residential property owners alike throughout the entire state of Florida. I've been at the firm for 10 years. Harvey Cohen, the owner, has been doing this for 20 years. We've got over 55 lawyers at the firm. I'm from Louisiana, so I may have a little draw, but hopefully you can learn something today. I've handled countless claims, and I've been working with Tara for a really long time. And like I said, hopefully y'all can learn something today. If you have any questions at the end, just let us know.
And lastly, we have Tim Reedy from Custom Restoration. Custom is a very elite restoration company that handles large city government projects, hospitals, and large multifamily. Tim, do you want to introduce yourself?
Yes. Thank you, Tara. Like she said, I'm with Custom US. We're one of the largest solely owned restoration companies in the US, and we serve hospitals, condos, multifamily, all across the commercial space. Fire, water, mold, settlement issues, and obviously hurricanes is why we're here. I've been with Custom for 10 years. So.
Absolutely. So when damage happens, this is what we're here to talk about. The first thing we're going to go over, and Jordan's going to take leads on this, is new laws that have gone into effect that actually affects your timelines and what you do. The history of how we got here and how prejudice can affect. So being that I've been doing this for 25 years, I've seen all this cyclical nature in claims. And where we are in Florida, remember, we had all these hurricanes in 04, 05, Charlie, Francis, Jean, Wilma, and then things settled down. For 13 years, we didn't have much of anything. So rates were going down, coverages were going up, the deductibles were still, relatively okay because people weren't feeling them. And then when Irma hit, it was this, whoa, we have these big deductibles, 500,000, 300,000, 600,000. Let's, as an association, hold off and not necessarily file a claim until we see what's going on. So people were waiting, and we were encouraging people to wait because we wanted to protect their claim record, but the laws have greatly changed, and that is no longer the case. Jordan?
Yep, thank you, Tara. So yeah, the laws have definitely changed. I was here prior to and during the onslaught of Hurricane Irma and Michael and Matthew and then Ian. Going back to Irma, the laws originally back and it kind of was the long-standing time frame for at least named storms and hurricane reporting requirements was 3 years. So At first people would, in associations and property managers, they would go outside after the storm and say, oh, it doesn't look like we've got enough damage to go over our deductible. Let's just hold off. And a couple of years would go by and they'd be battling leaks and leaks and leaks. And then on year 3, right before the statute of limitations would run for, and I'm giving you an example of Hurricane Irma right now, we see just a rush to the courthouse or a rush to make claims for Hurricane Irma before that 3-year statute hit, which developed some later case law and some more newer legislation changes. So after Irma in 2017 and then later in 2019 and 2020, the hurricane and the statute of limitations for the reporting requirement for after you notice damage shortened to 2 years. And then last year in 2023, it then shortened to 1 year. So the takeaway on this is speed really is the name of the game. No longer can an association and a property manager go out and say, let's cross our fingers. We see a little bit of damage here. Maybe it's a couple tiles on the ground. I don't think that it's going to be over our $50,000 or $200,000 deductible, despite a few damaged spots across 13 buildings on the property. We cannot operate like that anymore. The landscape and the industry of insurance, really the ecosystem of insurance in the state of Florida has changed to where, number one, you've got a prompt notice requirement in your policy, and now Florida statute is codified to say that you've got 1 year, as you can see on the screen, reporting requirement from the date of loss. And really what the carrier is going to focus on there is the date that the reasonable person would have noticed the damage. So if you, the association, which is the policyholder in the commercial residential context, or the property manager and agent thereof, actually notices damage after the storm, that's really when the trigger date starts, to where you say, hey, you've got 1 year from the date of loss. And then the insurance company is going to look at it and say, when did you actually notice that damage, to determine whether they were prejudiced or not. I know we're going to talk about the prejudice point a little bit later today. Dovetailing from the 1 year reporting requirement, now you have an 18-month supplement requirement. What a supplement is defined as in our world is you made your claim timely. Okay, so for example, you made your claim within the 1 year time frame. They adjusted the claim, they being the carrier, and they said that you were either under deductible or they paid you an undisputed payment. They paid you something. You go and do your repairs, and you are incurring more money than what the insurance company has paid you, or you have a building expert saying it's going to cost you more money than what the insurance company has paid you. Under the old law for Hurricane Irma, for example, you had 3 years from the date of loss to report your supplement. Again, it's a request for more money than what you received. Under the new law, which has been changed to the 1 year reporting requirement, now on adjusted claims from the date of loss, you have 18 months instead of 3 years to ask for more money on a previously adjusted claim. And then the last box is 5 years to file and contest a wrongfully denied or wrongfully underpaid claim. What that means is that if you've satisfied your reporting requirement of, hey, carrier, it's under 1 year, I've noticed the damage, I'm making a claim for my damage. And if you do have a supplement on a wrongfully underpaid claim, and you are going to probably have that in today's industry, unfortunately, which is why we all have jobs here, you've satisfied the 18th month supplement request. If those 2 boxes were preserved, then you can have a 5-year preservation period to still file the lawsuit. The reality of it is once most board members and associations and property managers were, for lack of a better term, shafted by their insurance company or not properly paid or otherwise wrongfully denied on their insurance claim, they immediately hire a professional such as a public adjuster or an attorney. And that 5-year, mark really you never really see it, because the attorneys and public adjusters that you hire oftentimes really aggressive in getting to the courthouse or using some alternative dispute resolution mechanism to expediently close the claim. But the takeaway from that slide is speed is the name of the game. Going back, you could wait a little bit, see where the damages were. Now you cannot do that. You must make the claim promptly and within 1 year on a new notice claim, and within 18 months on a request for more money. The courts are being very strict on that.
And What we're trying to tell you guys here is it's not from the 18 months from the day they actually decide and pay you the check. It's 18 months from the date of loss. And if you have a single family home and you have a dishwasher that overflows, that claim should be handled within a month, right? So you're thinking, okay, 18 months, it seems like such a long period of time. But when you're talking an association claim, it's completely different. The average association claim is well over a year versus the average homeowner claims is under 6 months. So if you're saying, wait a second, I might not even get the full determination of what they're going to pay me for close to a year, and then I have to go back and forth, how am I going to have the repairs done to possibly supplement? And that's really what we're taking away from here. On the timely reporting, Jordan, it says who knew when. And one of the things that you touched on that I think is very important is you said when a reasonable person should have known. But that also goes to when you do know. So before, way back in the past, we could say, oh, well, we did the repairs, but we thought it was going to be under the deductible, so we didn't file the claim. And if you give that answer in a deposition, how would that turn out?
It would not turn out well. And, unpacking that a little bit, it's when the reasonable person and or you actually knew of the damage and should have reported the damage. So insurance companies on commercial, residential, and condominium claims alike, they like to engage in the discovery process during the claim. We call it a request for information. And with that, they're going to be able to ask you questions under oath, you, the association, the board members, and sometimes even the property manager. And they're going to be able to look at board minutes. And one thing that the carriers adjusters like to do to devalue the claim or otherwise deny it under the basis of prejudice is look at the board minutes and see if they've had any mentions that were recorded in the board minutes of damage after a storm. And for example, if we had a hurricane that happened today and you have a board meeting in August and, Ricky Bobby in Unit 2D was, exclaiming to you in the board minutes that were recorded that there was damage, there's leaking in the roof, so on and so forth. And you didn't make a claim until 10 months later and after you've performed repairs, then that's where the case law is going to come to harm you. And there's been real cases in Florida where insurance companies found in the board minutes and actually gain knowledge that the association and the members of the community knew that the hurricane had damaged the property, whether it be through the written board minutes or actual deposition testimony. And then the association was battling leaks, whether it be temporary repairs, minor roof repairs, or more permanent style of repairs. The leaks kept on exhibiting themselves and making it worse and worse and worse. And then they made a claim. And then there's been a lot of case law that has come out that is unfortunately upholding the carrier side, saying, hey, if we were prejudiced, meaning if you did not give us an opportunity to inspect both at the time that you realized that was damage at the property and before you engaged in these repairs and altering the evidence, then we can legally deny your claim on the basis of prejudice. So this really goes back to what we were just talking about, which is speed is the name of the game here. Once you notice that there's damage on a property, especially after a named storm, tropical storm, hurricane, catastrophe like that, you must notify your insurance company so that they can not have the ability to argue prejudice and that you're fully transparent with them. You have nothing to hide, really. So carriers hate it when associations come and promptly report it and, open their books and say, we have nothing to hide, come look at the damage. Because another thing that you have to do is let them inspect your property. And the closest in time to the date of loss that the carrier's adjusters can get to the property is always going to be the best evidence for you for an expedient claim resolution.
So here's just some pictures because we always are talking about things, but these were cases that we've handled over the past. And this is where I want to show you that timely can be confusing. Yes, if all the roof is blown off, of course, you're going to call the insurance company. But what happens if you just have a couple leaks over? Where you see these X's is tiles that have been misaligned and they're loose. But if you look at it from the ground, you can't really see it. Yeah, you see a palm tree and maybe a broken tile. But when we look up underneath the tile, we can see it's been lifted. We can see the evidence of that scrape mark where the tile has been chattering, and we can see it disengaged. So these are things that as a property manager, as a board, you wouldn't necessarily see from the ground, and why you want to get experts and want to get the insurance company on notice. Here's an association in Orlando. It's 3-story buildings. And imagine if you just threw a drone up there, right? You think, okay, everything looks good. We just have a little ridge cap missing. And this is exactly what happened with this association. They didn't think it was that bad. But every time the wind blew, they kept on getting leaks and getting problems. When we went up there, this is popsicle sticks we put underneath to kind of show in a picture format that how the actual shingles had torn from their fastener, and that seal strip was completely disengaged and was on the other side. You can see how shingles had lifted and torn, but things that would be difficult to see from the ground. So this is why it's important that you still hire experts and report your damage timely. This is another example. Yeah, you could see that you have a dent, but you can't necessarily see scrapes from the flying debris all on top of the roof. Lastly, we're going to talk about windows. And we're going to hit on this later with wind-driven rain with policy limitations. But these are some of our associations in Panama City after Matthew, where they had water intrusion through the windows, and the insurance company said, no, that's wind-driven rain, we're not covering it. And there was actually damage to the windows and the seals. But you can imagine, like, a homeowner's not going to see this behind their curtains and their blinds. They're not going to know it's there. So reaching out to experts and timely reporting is important. Do you want to take a little bit on this part? We're going to go over disclosure, emergency powers, and deductibles. Let me go back.
Sure. There are a couple of components of the recent legislation. There's a beef up in the manner in which the association's records are maintained and responded to. Also, the requirement to maintain websites are now lowered. So the threshold now will be, it comes into play within the next year, 25 units or more will be required to have a website and post certain of their official records on that website. There's new procedures in place that we have to follow in connection with responding to a records requests, including checklists, providing documentation as to, well, why don't we have a record? The excuse of not having a record is not really it was never an excuse, but it's really now codified as not being an excuse. And there's enhanced penalties for noncompliance. So what does this translate to? So when I'm representing an association as their outside general counsel, we will get calls from people like Jordan who are representing the associations in litigations involving their insurance carriers, and there will be expansive discovery requests. And they're going to be asking for meeting minutes. They're going to be asking for budgets. They're going to be asking for inspection reports. There's a myriad of things that at first glance, my boards and say, well, why do they need this? But the reality is that they know that you have documentation as to the condition, or you're supposed to have documentation as to the condition of the property prior to the loss. They also know that you're supposed to have documentation as to the condition of the property immediately after the loss. So they know that you have those documents. If you say you don't have them, now there's a statute that's in place that says, well, wait a second, you had a statutory obligation to your unit owners, not to a third party, to produce. You have to keep in mind that it is a subject of discovery, and now it creates a situation where an association doesn't properly maintain its records. Although the new statute is really meant for internal governance of the association, meaning the unit owners and the association management, the insurers are looking at what is required of associations, and they're going to hold you to it, that you've maintained the same records and you perform the same inspections that are being required.
The meetings, you want to talk a little bit about that?
So, associations should have regular board meetings. The reality is that some associations have one meeting a year, some have monthly meetings, some have quarterly meetings. The statute's now been codified to require at least quarterly meetings every year. And during those meetings, you have to discuss construction projects and progress, revenue and expenses. You're also required to obviously take questions from the membership on all agenda items. This comes into play because in discovery, so this all, when Jordan takes over the case, in essence, there's going to have to be, they're going to ask for the meeting minutes and copies of the meeting notices. And those meeting minutes are going to reflect whether or not there was any discussion as to the expenditures for the year. There's going to be discussions as to what mitigation efforts maybe you undertook. There's going to be discussion about what if there was pre-existing, and I don't want to get into your fields, but this is what's come up. That discovery is aimed to determine whether it was pre-existing damage that was not related to the storm. All that information is going to show up in your governing documents of your association, in your meeting minutes, in your notices, in your agendas. So that's why this discovery expedition starts to get very burdensome on some of our associations. The reality is, if you're maintaining your records adequately, this is just an easy handover to your attorney. But we know that some associations don't have documents. I can't fix the past. This is what I tell my clients. But we can start as of today to do things correctly, and you can start maintaining your documents in an appropriate manner correctly today, so that if you do have, unfortunately, if we're going to have a hurricane this year, you already have a head start for preparation for your claim later on. So it's important to understand that there's the only emergency powers that an association has are those emergency powers that are enumerated in the statute, and they only kick into play when a state of emergency is declared by the governor, or where it's pursuant to statute when a state of emergency is declared. So whatever emergency action you take in connection with a storm, it has to be reasonably related. So this is not a free-for-all. The fact that there's a declaration of an emergency doesn't mean that we get to go do whatever we want, regardless of what our governing documents say. The goal is to always try to fall in line within your governing documents, but to have a little bit of leeway so that you can operate your association during the emergency to get you out of that emergency. Some of those powers include, and you could read the slide on your own, but they have the ability for the association to contract for certain services to prevent injury or damage. That would be retaining your mitigation services. They have the ability to levy a special assessment. Some governing documents require a prior unit vote for the levy of special assessment, but in the event that a emergency is declared and emergency powers are enacted, we would be able to bypass that vote. Now, there are measures that you can take to even avoid this and be proactive outside of the emergency so that none of this gets called into question. The other options are to be able to obtain loans to fund emergency repairs. Again, with loans, I would prefer to be proactive, and we can talk about it a little bit later. Perhaps get a line of credit ahead of time for such an emergency so that you don't have to tap into these powers. You already have a plan in place to address some of these needs.
A little bit about this because it's different than other assessments. This is not like we're doing a concrete restoration project or we're adding an extra slide to our pool. This is for your hurricane deductible. And under the statute, if you purchase an HO6, which is a homeowner's policy for a condominium, and it's just regular admitted carrier, some investors do things a little bit differently. But if you're just a regular mom and pop that own a condominium, most likely you have a traditional HO6 policy that provides you up to $2,000 worth of coverage, a minimum of that. It could be more, with a maximum of a $250 deductible. It could be less, for an assessment that the association makes for their hurricane deductible. Now, you have to have wind coverage under your policy. I was very surprised up in the Panhandle after Michael, there was many unit owners that didn't have coverage for wind. So if there's no coverage for wind and it's a wind deductible, they're not going to be covered. It has to be covered under your policy as well. But there's the loss date. That's the date that the actual damage happened. That's the storm date. But then the trigger date is a little bit different. That's the date that the board votes to levy that loss assessment or special assessment for the hurricane deductible. The person that gets the assessment may or may not have been the person that owned the condominium when the loss date occurred. Remember, because there's nothing to say that this has to be within 30 days or 100 days or 200 days. There's no actual date that needs to be on there. But the person that owned the condo before you would have had to have an HO6 policy as well. You can't just go out and buy one, and the insurance companies have kind of figured that out and wrote that out. And then the third thing you have to do is actually collect it. So there's nothing that says it has to be collected in 30 days. You might give people a little time and say 90 days. But the big takeaway that I've seen most mistakes made over the last decade of working with associations is associations waiting, because they sit there and they say, well, we have some money for a deductible. We have some money in our roof. We're going to talk about where to pull these deductibles from on the next slide. But they're saying we have some money. We want to wait until we figure out what's getting paid, what's not going to be paid, how much it costs. The policy is very clear. The deductible is the first money spent on the loss. Whether it actually happens that way, it doesn't matter, but Jordan's going to talk about how the statutes have changed and the case law has changed a little bit on that. You are expected to spend your deductible right away. You cannot wait, because this is what happens. All of a sudden, it goes from waiting from 30 days to 60 days to 6 months to a year and a half. Now you have to get a regular vote, a membership vote. You can't get it. People have moved. People are complaining because I wasn't even here before. Listen, you're on the board. You have a hurricane. You need a deductible. There's literally coverage out there. It's free money that people already have paid for with their premiums. Go and take it. If you don't, and you just use the money out of your reserves, what happens if there's another hurricane next year? You're crazy not, in my humble professional opinion of 25 years, you are crazy not to collect the hurricane deductible from your unit owners right after the loss. You can always give it back. If you don't need it, you have enough money in reserves, you can always give it back, but it gives you the ability not to be leveraged by your insurance company. They won't be pressing the finger on you and you're like, I don't know what to do. We can't afford it. Where are we going to get this money from? You're able to make the decisions that you need to make on the board and be able to move forward.
Generally speaking, the money that you have in your operating account should be, it could go towards the deductible. When I'm asked, can we use the money from reserves to pay the deductible? Well, the answer is possibly yes. So let's say you have to put on a new roof after a storm, where you have reserves that you've collected for roofing related repair, maintenance, or replacement. So technically, you should be able to use the money that's in that reserve account for the replacement, repair of your roof towards the deductible. Okay, so what you spend on that roof will be counted towards the deductible. You don't have to replenish the reserve. What happens is once your roof is repaired, that has to be taken into account into your reserve calculations, and it gets adjusted. Another option that that is available, and many of our associations do this during the what I call the off season, is speak with your lender about obtaining a line of credit to fund emergency purposes. So what you do is you go through the entire loan process. You obtain a line of credit, which would be sufficient to cover your deductible amount and perhaps any immediate costs that you have to incur after the storm. You go through the necessary approval process with your association to have all that in place so that when the storm comes, you're ready to go. You have the money that's available to pay for your deductible and to conduct whatever necessary mitigation repairs you have to do, because let's face it, the money from the insurance company may not come in right away, but your obligation to repair and restore your property is immediate. I think I've covered it. Oh, the other one, I've had some associations create a separate line item in their operating account for kind of like a deductible piggy bank. I mean, if you're that prepared, you probably already considered a line of credit as well, and you should, you have your ducks in a row. So there are different options for doing this. The good thing is to do some of this preparation in the off season, because that will give you a head start when it gets hectic around here.
So now we have some coverage limitations to be made aware of. I found that many times associations, it's been years since someone had a personal claim and they're not really familiar on how payments are made because they're not necessarily made the way that you would expect them. Do you want to explain RCV and ACV? Because everyone thinks, oh, I have a RCV policy, I'm going to get paid everything at first.
Are you talking to me, Tara?
Yes, please, Jordan.
Thank you, Tara. Before we get into even the RCV, ACV discussion, I want to counsel everyone that's here today that they have a homework assignment. When this video is done, please email or call your agent. And I always recommend that you put it in writing, because once you put it in writing, Florida statute triggers the time frame on which they have to provide to you a certified copy of your property insurance policy. Obviously, that covers for the association, okay? A certified copy of the policy. That is your buzzword under Florida statute, a certified copy of the policy. 99.9% of the associations that Tara and I represent, and Carolina that represents, when we ask them to give us a copy of the property manager, hey, give me a copy of your property insurance policy. It is a PDF copy of 10 pages. Oftentimes, it's not even the property insurance policy. It's like the GL, the general liability policy. I'll say, give me the property policy, and it's still 10 pages, which are just the declarations pages. Oftentimes, not even a full set of the declarations pages. They're uncertified. And what certified means is that you've got every single page in your declarations, the main form, and all of the endorsements from jacket to jacket signed by an executive officer of your insurance company. And what that tells you is that now we can look at the policy as a whole and see what you have in it, what limitations are there, and then we'll go into and see whether you've got this RCV, ACV, coverage limitations, and how the money's being paid, so on and so forth. Some provisions that you do need to look out for, and then we'll get into the RCV, ACV thing, is whether or not your property is actually insured at only actual cash value, or if there is a sublimitation that only insures you at actual cash value. Another thing is law and ordinance. We're going to discuss that. Co-insurance penalties. The very basic general description of what a co-insurance penalty is that if you haven't insured your buildings, let's say you got 10 buildings and the rebuild costs for 10 buildings are 100 grand a building, but you're only insuring them at 80% based on the total insurable values list that you deal with your underwriter. That's another thing you can request from them, is a TIV list. Oftentimes, that is the schedule of properties and the values of which you have paid to insure them at. A co-insurance penalty, not most people have, but some people do. And it's the people that don't know they have it is when it causes problems. The basic general description of what a co-insurance penalty is if you've only insured your property at, for example, 80%, then if you have a roof claim, you're only going to get 80% of the cost to rebuild your roof. Oftentimes, again, minus depreciation and minus your deductible. So you may end up with 50 or 60% of the cost to rebuild the roof. Now,
most condominiums are agreed value. I've seen a lot that are 80 and 90% insured to value. If you have a co-insurance, does not mean you're going to get paid at 80%. It means if you're not insured to at least 80% of value, then there'll be a deduction. So I don't want everyone to worry about that. If you're working with an agent that's CIRM certified, that specializes in condo law, you get your appraisal done, that shouldn't be a problem for you, but is something to watch out on.
Let's unpack RCV and ACV. RCV is an acronym just like ACV, and it stands for replacement cost value and actual cash value. There are policies, most policies insure at replacement cost value. There are some that insure at actual cash value, and there are some that have RCV valuation with sublimitations, for example, roofs or windows that would be insured at actual cash value. Do not let the term cash fool you. You generally don't want actual cash value. And the reason why is because replacement cost value is what it is. It is what it says and it does what it says. It pays you the cost to replace your damage, whether it be your roof, windows, the rebuilding of whatever aspect of the property that was damaged by the storm or your covered loss. You incur those costs, you are paid back those costs. It quite literally pays you the cost to replace that damaged property, generally speaking, less your deductible. And that's what you typically want on every aspect of your property and all of the sublimits. You want it to be insured at replacement cost value. What actual cash value is a simple mathematic formula where it's the replacement cost value minus the depreciation, and that leaves you with the actual cash value. But they're also going to take away the deductible. So as you can see in the example on the slide, you've got a roof that's 12 years old that has an expected sustained lifespan of 30 years. There's 18 years left on the roof. We're going to deduct that 12-year mark because it's been depreciated for 12 years, as you can see on the slide. So your actual cash value adjustment on a $100,000 roof at a 30-year expected lifespan minus the 12-year depreciation adjustment will leave you with 59,000 and change, and then we're going to subtract the deductible from there. So you may only end up with 35 or 40,000 depending on what your deductible is in this general hypothetical description. Some people that have this actual cash value endorsement on the roof, and that's why I'm using that example because it's on the slide, do not know that they have it, which is why you need to get and keep a certified copy of your policy for every single one of the properties that you manage. If we have CAMs and I know that we do, property managers that are viewing today, so that you can know if you have the actual cash value endorsement and where it lies on your property. And you can ask questions of your broker to see if there's something that you can do to upgrade your policy to a replacement cost value policy. Just because you have actual cash value, it doesn't mean it's a horrible thing. You just need to know about it ahead of time, know about it before the storm, and have a plan of action, both physically and financially, after the storm so that you can be prepared.
You might have an 18-year-old roof, and the bottom line is no one is going to give you a RCV on your roof because they don't even want to insure you. So these aren't just like easy changes. I live in a home built in 1957. It's a beautiful home. Everything's new, but I still have the hardest time getting insurance, even for my regular single family home, because of the age of the property, even with an inspection and everything else. It is the market in Florida. It is very difficult. One last thing I want to talk about, and you just made an interesting point, or have other measures. So the association, if they know that they only have an ACV on the roof, they might need that much more in reserves just in case something happens, so that they know, okay, we can't buy it in insurance, but we have the money sitting in the bank to cover it. But the replacement cost is not a given. It's a replacement cost, and I should have put the word benefit. It's an endorsement on the policy, and the policies are all very clear that as the insured, you only receive that benefit if and when you incur the expense. So the initial payments will be the actual cash value payment up front. So if you have a $100,000 roof, when they give you the money for the roof, they're still not giving you the RCV up front. They're only giving you that depreciated amount. And then once you show them, hey, we're going to go out and spend the full $100,000, then you get your benefits of the difference. You get that depreciation back in a second payment. Now, that goes to show where associations like, I'm going to go and get 15 estimates for the roof, and I'm going to get it done for 80,000. So then I don't have to pay the deductible. It doesn't work like that. Then they redo the calculation and they say, okay, 80,000 less your deductible. Here's the depreciation you get back. You cannot beat the system. You just have to understand how the system works, and you have to do your due diligence to get the roof replaced as soon as possible and as timely as possible.
And Tara, if I could mention one of the legal updates regarding the replacement cost benefit, regarding the deductible that we were all talking about earlier. The old law, you get the replacement cost benefits. It actually, prior to the second change, you had a loss and you were paid replacement cost benefits. Then the law changed to say once the work was done, you get the replacement cost benefits from the depreciation if you have a replacement cost benefits policy. Now, the carrier can require you to show proof that you've actually collected and spent the deductible before they pay you the finality on the replacement cost benefit. So that means getting the work done and actually incurring the value of your deductible as well.
And that's a massive, massive change. I should have put like
Yep.
alert, because before you wouldn't have to prove it. And now they're like, no, we want to see that you've actually wrote a check for that deductible to somebody. You're not going to write it to the insurance company. You're
Right,
going to write it to
Tim.
the vendor, to Tim, probably.
Right, to Tim. As soon as the loss happens, oftentimes carriers will agree to advance payments. What the associations need to understand is oftentimes those advance payments, number one, are not delineated on what you need to spend them on. Sometimes they are, and if they are, you follow the guidelines from that adjustment, but 9 times out of 10, it is what it is. It is an advance payment to help mitigate your, onslaught of damage that you just happened and help quickly start picking up the pieces and mitigate further damage. The key here with the advance payment, if you do get an advance payment right out of the gate from the carrier, which is great, you need to spend your advance payment. If you do not spend your advance payment and you put it in the reserves or your operating account and you're waiting to get 10 to 15 different bids from 10 to 15 different, chucking of trucks and toothless Joes, then you're not going to be getting a great, claim payment on your undisputed, which is where I'll go next. An undisputed payment means that the carrier has done their inspections, they've asked their questions and they've done their adjustment of the claim. And it is either an initial or some type of payment in the adjustment of the claim. It could even be their quote unquote final payment, but it is what the carrier has agreed was damage from the cause of loss. They've agreed on the damage that they see, that they've estimated, that they've adjusted for. And that's what they have paid to you on a delineated adjustment with an estimate that's typically a line item by line item estimate, which is different from an advanced payment. Advanced payment typically doesn't have a breakdown. It's a right after the storm check. And undisputed is an after adjustment delineated line by line payment. Usually it is your first check, which is called the actual cash value check, where the second check, which is the recoverable depreciation, if you're insured at replacement cost benefits value, that would be called your undisputed payment. Let's just say you have $1 million loss with a $200,000 deductible, which replacement cost of benefits would give you $800,000 in benefits. Okay. But the carrier doesn't necessarily see it that way. They think that you're only entitled to $500,000. So they may have adjusted it at $700,000 minus $200,000 deductible. They've given you $500,000. And you've got Tim, who's going to come in and do all of the mitigation and do a detailed estimate, working together with Tara and Caroline and myself, and the entire price to put you back in pre-loss condition, which under Florida law, under an RCV policy, the carrier is legally required to put you in pre-loss condition, would cost you $1 million, again, in this hypothetical. So you've got a supplemental claim of $200,000. Going back to the beginning of our presentation, you have 18 months from the date of loss to preserve your ability to recoup that extra $200,000, which again goes to the point that speed is the name of the game, and hiring professionals early that are experienced and know what they are doing in this industry so that you can be put back in pre-loss condition for the least amount of out-of-pocket expense and burden on the association that can occur. The last thing from that is final. That was seen on the screen. Finals after supplement. Final's the last payment. It usually closes the claim in exchange for a release, or maybe you've gone through the appraisal process. It is quite literally the final payment. Most of the time, the carrier is going to ask for a release if it's a negotiated resolution. We call it a global resolution. And what I see from carrier or from associations in the past, especially after Hurricane Irma in 2017, is that we had uneducated and uninformed board members who didn't have a plan after the storm, didn't have designated individuals with enacted emergency powers, and did not hire professionals. Carriers were coming out, sending advance and undisputed payments, and board member Jimmy Neutron was just signing a release for the undisputed payment. 9 times out of 10, once you sign a release, the claim is done. You will not get a supplemental payment or a final payment. I don't care if you've got a supplement that's $10 million from damages that exhibited themselves 6 months after, Jimmy signed the release. Once that release is signed, you will not get any further supplemental payments. So prior to agreeing to any final payment on an insurance claim, I highly, highly, highly recommend that you hire a professional contractor, a professional public adjuster, and a professional first-party property claims attorney like Cohen Law Group.
Jordan, you explained wind-driven rain. I'm the host.
Yeah, it's okay. So wind-driven rain.
Quickly.
Yes. All right. Wind-driven rain. Policies cover wind-driven rain, or they cover wind-driven rain after a peril-created opening, like wind has damaged the property and allows rain to come in. You also have flood damage that is different, that is bottom-up water compared to top-down water. Wind-driven rain will not be covered by your flood policy, and flood will not be covered by your wind policy. So you need to make sure that you have adequate coverage in that. And Tim will explain to you the importance of why you need to hire a professional who's experienced in mitigating both floodwater damage and wind-driven rain water damage. And if you do not hire one, you may be up a creek and not getting and you will not receive payment from either the flood carrier or the wind carrier.
So I need one last piece of information from
Yes.
you, because I've seen you successfully deal with this with clients before. What happens if an association gets a non-renewal letter from their insurance company in the middle of a claim?
Florida Statute 627.4133 has been amended and is now codified to state that carriers are legally prohibited from canceling or non-renewing your policy during a pending claim. So if you have a
But
pending
then they won't do it,
claim,
right? If it's illegal,
correct, they
won't do
have
it.
to continue renewing. I do not care if you get that letter during a pending claim, you give me a call.
The
Okay.
point is, you're going to get the letter anyways,
You're
even
going to
though
get the letter
it's illegal
anyway.
and they're not supposed to do it. Remember, these carriers work all over the country, and some of them, many countries. So they don't necessarily know or follow the Florida statute, and you can't just say you can't do it. I can tell you from experience, you're most likely going to need your general counsel or a first party counsel to be able to fight the insurance company if you get the non-renewal letter. Advice on how to get through that process and recommendations for restoration, Tim.
Thanks, Tara. I think that, the biggest thing is having on the screen a pre-loss agreement. We call them master service agreements, but what they do is they help us define what sort of resources and how we can respond if you do have a large loss. And we do, we address daily losses as well, but the, large losses that are going to, come with where we've set up, how much equipment, how we are going to bring resources on site, and how many resources we need as far as to allocate to your property. So getting the pre-loss agreement and getting with your condo association to understand what that entails is very important. And then if you do have a large loss, going into preparing a rough order of magnitude, which is kind of establishes the size of your loss and how we're going to help you pay us is very important. It goes in, they're talking about daily burn rates on the screen, and we may also discuss a daily cost so that you know what you're up against. And then as far as going into securing your building before drying, a lot of companies will get on site, place equipment right away, and you're already paying for equipment that is not drying your property because nothing's been done to stop the water from entering your property. The most important thing is to secure any roof, any penetration into the building, and make sure that we are able to dry the building and we're not just pushing water around.
And that makes the insurance companies mad. There's nothing worse than they run up $100,000 bill and then it rains and everything gets wet again. And they're like, what are you talking about? Like, what are we doing here?
Yep.
So making sure that you have a reputable company to do that is key.
And most times that is part of if we have, which we try to avoid, if we have arguments with the insurance company about our bill or about an invoice is because we didn't take the necessary precautions to effectively dry the space. And then, it helps, I think getting that back to the pre-loss agreement, it helps us provide insight into what's happened before to your building. What are the sticking points as far as things you've had in the past that may affect the current loss? Understanding the wind versus flood, as Jordan stated, we make sure that we are addressing each separately, because that's what it's going to take to get your damage covered. So,
And the way flood works is not like wind. Like wind makes you whole. Flood is never to make you whole. There's very limited coverage. It's the government. It's like, it's the IRS. These are the rules. They're going to pay for what they pay for. Their paperwork has to be done a certain way. Their math has to be done a certain way. And if you put it in a certain way that fits in the form, it will get paid. And if you turn it in like you're turning in a wind claim to the carrier, it's not going to get paid by flood. So having a company that understands those differences are really critical.
and then keeping a team, we provide most of the team members to you as far as engineers, contractors, that sort of thing. But having Jordan and Tara and Carolina on your team prior to season, even though we're in season, and we could still do it now, but prior to season is a great way to keep you prepared for what possibly might come.
And so also I wanted to add here, like I've seen now everything's great day one, right? That's like I always tell people, the first day of construction is going to be the best day. It's only going to go downhill from there. That's when everybody's smiling, before the trash, before you hear the hammers, before everyone's tired. So remember who showed up. Now, what happens is, and I've seen it over and over and over again, now we're into 6 months, right? And they've been drying, and then there was another storm and things blew off, and the insurance company's dragging their feet and they're not paying. And all of a sudden the insurance company now is dividing the wedge between you and the contractor, the one that shows up. And that wedge and that dispute causes lack of communication, and then the leverage, the only person that benefits from that is the insurance company. When I say keep a team with your restoration company, you have to keep open lines of communication. And remember, when you were all wet and you needed someone to show up, they showed up and they did the job. The insurance company is never going to want to pay the restoration price. It's just, they don't. It's against their nature just to say, sure, we're going to pay it. There is always going to be some discussion and some dispute and some working it out, figuring out if it's wind-driven rain or if it's in this bucket or that bucket, wind or flood. But you can work through that with open communication. Once everyone starts infighting, that's when the only person that loses is ultimately the association.
There's a lot of ongoing operational agreements that need to be looked at by your association to determine whether your contractors, your vendors have a hurricane policy. So your management companies, for example, I review management contracts regularly. Some of them will have a provision in there that says that in the event of a storm, dealing with insurance claims related to the storm, dealing with major construction projects, so on and so forth, will be a charge over and above the regular management fees. Some of them tie them into a percentage of the cost. And I don't even know if that's recoverable under insurance. I'd leave that to you, Tara, to you, Jordan. But I know that management companies routinely put these clauses in for these types of major events, because obviously it's way outside the scope of their representation, and they want to be compensated. Landscaping companies. So whenever I negotiate a landscaping contract, I ask for the hurricane policy. What is their cleanup policy? How much are they going to charge you for the cleanup? Because you want to make sure you negotiate those prices ahead of time so that they're bound to it, and then you're not stuck in a bind after the fact where there could be price gouging or there's a shortage in supplies. They will be held to those contracts. If you are, like many of our associations, undergoing restoration projects, concrete restoration, you have cranes up there, you have swing stages, you need to have a hurricane plan built into your contract. You need to know when they have to mobilize, when they demobilize, what the process will be, what the cost will be as far as manpower. I mean, I aggressively try to see if we could get like a freebie, a free demobilization in some of my big contracts. Not always successful, but a girl's got to try. But those are things that you want to take into consideration. You want to take into consideration reasonable response time. You have security contracts. What happens in the event of a storm? You know, some associations lose their security personnel during the storm. Who's going to operate your major equipment, things of that nature? All of that should go into your hurricane plan, and every single vendor that you have on site should have a hurricane course of action, hurricane plan, and if there are costs related to it, negotiate them ahead of time.
Stone Building Solutions, we do offer public adjusting services, and we are a lot of people on this webinar. We are your engineer of record. We can't be the engineer and the public adjuster at the same time, so we always like to talk about the loss and see where it fits. But ultimately, having us involved, because we've looked at your property before, we understand what we're looking at from an insurance eye, not just an engineering eye, can be helpful. The manager, the board, you need to have your agent involved. Now, your agent, they sell you the policy, they're not the claims adjuster, but keeping them aware of what's going on is critical. Your CPA, your reserve advisors, your EMS contractor, all of these people on the same page is what makes for a successful outcome. So if your roofs or windows are old and you are 15 miles from the coast and you're thinking about replacing these in the next couple of years, it would be very smart to apply for this grant money. If you're going to do it anyways, or you know you're going to have to do it for insurance, this is the opportunity. With the increased cost of insurance and inflation and the reserves that you have to fund for, it's a nice little break for the association. That concludes our presentation, and we are so thankful that you joined us today. And I know our panel has to leave. If you have any other questions, you can email me directly, Tara, T-A-R-A, @stonebldg.com. And Jordan, do you want to tell everybody how to reach you? And we can just kind of go through the line.
Yes, so our office line is 407-478-4878. I'll repeat myself, it's 407-478-4878. Our website is at the bottom of our logo on the screen. It's aboutjustice.law, and we represent on a contingency basis. So if you have any questions about any claim, a policy provision, we do not do hourly billing. So you could give us a call and we'll guide you through the process. And if we can help you out with representation, then we can certainly do that as well. Hopefully we don't get a storm, but if we do, hopefully after today, you'll be prepared. Thank you all for being here.
Carolina, how do we get in touch with you?
Certainly. Our office number is 954-894-8000. And you can find us on our website, www.eisingerlaw.com. And my email's on there. But if you need to email me, it's cshear@eisingerlaw.com.
And lastly, if they want a pre-loss agreement with custom restoration, how do they do that, Tim?
Yeah, it's pretty easy. Our website's easy, custom, KUSTOM.us. And if you want to call direct, we have an emergency line that also goes to a direct line. It's 866-679-0699.
Yeah, custom with a K.us, not .com. I've made that mistake before.
No worries.
All right, everybody. Thank you so much for attendance. This was just an informational webinar. We did not submit it to the DBPR in enough time to give you credit for it. But what you do get is the information that will maybe get you millions of dollars, which hopefully is worth more than credit. Thank you so much for logging on. Again, Tara Stone with Stone Building Solutions. You can catch this on our YouTube channel. And I hope everybody stays safe this storm season. Have a good day.